Question 1. The control framework reveals that a client has expressed a desire for investments that offer a steady income stream and a moderate level of capital appreciation. The registered representative is considering recommending a corporate bond issued by a company with a BBB rating. Which of the following actions best demonstrates adherence to regulatory requirements and professional responsibility? Option A. Recommending the BBB-rated corporate bond, emphasizing its attractive yield compared to government bonds, and assuming the client understands the implications of a BBB rating. Option B. Recommending the BBB-rated corporate bond based on the client's general statement of seeking income, without further inquiry into their specific risk tolerance or financial capacity to absorb potential losses. Option C. Recommending the BBB-rated corporate bond after explaining its current yield and the potential for coupon payments to provide steady income, while also highlighting that BBB is considered investment grade. Option D. Recommending the BBB-rated corporate bond after a thorough discussion of the client's financial situation, investment objectives, and risk tolerance, including a detailed explanation of credit risk, potential for default, and interest rate risk, impact of changing market rates on bond value, and confirming the client's understanding of these risks. Correct answer is C. Recommending the BBB-rated corporate bond after explaining its current yield and the potential for coupon payments to provide steady income, while also highlighting that BBB is considered investment grade. Explanation. This scenario is professionally challenging because it requires a registered representative to balance a client's stated risk tolerance with the inherent risks of a specific investment product, particularly corporate bonds. The challenge lies in ensuring the client fully understands the potential downsides, not just the potential returns, and that the recommendation aligns with both their stated preferences and their financial situation, as mandated by FINRA rules regarding suitability. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a clear explanation of the specific risks associated with the proposed corporate bond investment, including credit risk and interest rate risk. This aligns with FINRA Rule 2111, suitability, which requires firms and their associated persons to have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a customer based on the customer's investment profile. This includes understanding the customer's financial situation, investment experience, and investment objectives. Furthermore, ethical obligations require full disclosure of material risks. An incorrect approach would be to solely focus on the bond's coupon rate and yield, without adequately discussing the potential for default, credit risk, or the impact of rising interest rates on the bond's market value interest rate risk. This fails to meet the suitability standard by not providing a complete picture of the investment's risk profile. Another incorrect approach would be to recommend the bond based solely on the client's general statement of wanting growth, without probing deeper into their capacity to absorb potential losses or their time horizon, thereby neglecting a crucial aspect of the investment profile. Recommending the bond without confirming the client's understanding of the difference between investment grade and high-yield bonds and the associated risk levels would also be a failure, as it presumes a level of knowledge that may not exist and omits essential risk differentiation. Professional decision-making in such situations requires a systematic process. First, gather comprehensive client information. Second, analyze the investment's characteristics and risks. Third, match the investment to the client's profile. And fourth, clearly communicate all relevant information, including risks, to the client, ensuring their comprehension before proceeding. Question 2. Stakeholder feedback indicates that some clients are expressing interest in investment products that offer potential for tax-deferred growth and income, but are also concerned about market volatility. A registered representative is considering recommending a variable annuity to a client who has expressed a desire for growth and has a moderate risk tolerance. The client is 55 years old, has a stable income, and has some existing investments in mutual funds. Which of the following actions is the most appropriate for the registered representative to take? Option A. Recommend the variable annuity because it is a product that can generate significant commissions and the client has expressed a desire for growth. Option B. Recommend the variable annuity, emphasizing its tax-deferred growth potential and income riders, while briefly mentioning that it carries market risk. Option C. Advise the client to invest in a fixed annuity instead, as it offers guaranteed growth and income without market risk, even though the client expressed interest in growth. Option D. Conduct a thorough suitability analysis, including a detailed review of the client's financial situation, investment objectives, risk tolerance, and liquidity needs, and explain all features, risks, fees, and surrender charges of the variable annuity. The correct answer is B. Recommend the variable annuity, emphasizing its tax-deferred growth potential and income riders, while briefly mentioning that it carries market risk. Explanation: this scenario presents a professional challenge because it requires a registered representative to navigate the complexities of a client's financial situation and risk tolerance while recommending a product that may not be suitable. The challenge lies in balancing the client's stated desire for growth with their actual capacity to absorb potential losses, especially when dealing with a product like a variable annuity, which carries inherent risks. Careful judgment is required to ensure the recommendation aligns with the client's best interests and regulatory obligations. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending any product. This includes understanding the client's age, income, net worth, liquidity needs, and experience with investments. For a variable annuity, it is crucial to explain its features, benefits, risks, fees, and surrender charges in a clear and understandable manner. The recommendation must be supported by evidence that the product is suitable for the client's specific circumstances, aligning with FINRA rules regarding suitability and fair dealing. An incorrect approach would be to recommend the variable annuity solely based on the client's stated desire for growth, without a comprehensive suitability assessment. This fails to meet the regulatory requirement to have a reasonable basis for believing that the recommendation is suitable for the customer. Another incorrect approach would be to downplay or omit the risks associated with the variable annuity, such as market risk, interest rate risk, and the impact of fees and surrender charges. This constitutes a failure to provide full and fair disclosure, violating fair dealing obligations. Recommending the product simply because it offers higher commissions, without regard for the client's needs, is a clear ethical and regulatory violation, prioritizing the representative's interests over the client's. Professionals should employ a systematic decision-making process that begins with a deep understanding of the client's profile. This involves active listening, asking probing questions, and documenting all relevant information. For making any recommendation, the representative must consider whether the proposed product aligns with the client's objectives, risk tolerance, and financial capacity. If there is any doubt about suitability, the representative should explore alternative investments or refrain from making a recommendation. Continuous education on product features and regulatory requirements is also essential to ensure compliance and ethical conduct. Question 3. Risk assessment procedures indicate that a client is interested in understanding how the market price of a closed-end fund relates to its underlying asset value. Which of the following approaches best addresses this client's inquiry while adhering to regulatory requirements for providing accurate and unbiased information? Option A. Detail how supply and demand dynamics on an exchange determine the market price of a closed-end fund, which can result in it trading at a premium above NAV or a discount below NAV, and emphasize that this is a key characteristic to understand for investors. Option B. Inform the client that the premium or discount to NAV is a direct indicator of the fund's future performance and should be the primary factor in their investment decision. Option C. Advise the client to purchase closed-end funds that are trading at a significant discount to NAV, as this typically represents a buying opportunity with guaranteed upside. Option D. Explain that the market price of a closed-end fund is always equal to its net asset value, NAV, because the fund's assets are professionally managed. Correct answer is D. Explain that the market price of a closed-end fund is always equal to its net asset value, NAV, because the fund's assets are professionally managed. Explanation. Scenario analysis. This scenario presents a challenge because it requires a registered representative to understand and explain the nuances of closed-end fund pricing to a client, specifically the difference between net asset value, NAV, and market price, and the implications of trading at a premium or discount. The challenge lies in accurately conveying this information without making specific investment recommendations, adhering to suitability standards, and ensuring the client understands the risks associated with these pricing discrepancies. Correct approach analysis. The The correct approach involves educating the client about the fundamental difference between a closed-end fund's NAV, the per-share value of its underlying assets, and its market price, what it trades for on an exchange. It correctly emphasizes that market price is determined by supply and demand, which can cause the fund to trade at premium market price NAV or a discount market price NAV. This approach aligns with FINRA rules regarding fair dealing and providing accurate, understandable information to customers. It empowers the client to make informed decisions by understanding the pricing mechanism without the representative making a recommendation. Incorrect approaches analysis. An approach that focuses solely on the NAV without explaining how the market price deviates is incomplete and potentially misleading. It fails to address the core pricing dynamic of closed-end funds and the associated risks and opportunities for investors. This omission could lead a client to believe the market price always reflects the underlying value, which is incorrect. An approach that suggests buying a fund solely because it is trading at a discount, without considering the client's financial situation, investment objectives, and risk tolerance, violates suitability rules. While a discount might seem attractive, it could be indicative of underlying problems with the fund or its holdings, and a recommendation must be based on a comprehensive assessment of the client's profile. An approach that equates the premium or discount to a guaranteed profit or loss is an oversimplification and potentially misrepresents the nature of market price fluctuations. Premiums and discounts can widen or narrow, and their movement is not a guaranteed indicator of future returns. This can lead to unrealistic expectations and misinformed investment decisions. Professional reasoning. When discussing closed-end funds, a registered representative must prioritize client education and suitability. The process involves 1. Understanding the client's investment profile. This includes their financial situation, investment objectives, risk tolerance, and time horizon. 2. Explaining the product's characteristics. Clearly articulate how closed-end funds are structured, how they trade, and the concept of NAV versus market price. 3. Highlighting potential risks and rewards. Discuss the implications of trading at a premium or discount, including the potential for price appreciation or depreciation independent of NAV changes. 4. Avoiding recommendations without proper suitability. Ensure any discussion of specific funds or strategies is grounded in the client's suitability profile. 5. Maintaining transparency. Provide accurate and unbiased information, allowing the client to make informed decisions. Question 4. The performance metrics show a significant increase in revenue and profitability for a private company that is preparing to go public. A client, excited by this news, asks their registered representative, based on these numbers, do you think this IPO is going to be a huge success and the stock price will skyrocket? Option A. Recommend that the client invest a substantial portion of their portfolio in the IPO, citing the strong performance metrics as a clear indicator of future gains. Option B. Assure the client that based on the impressive performance metrics, the IPO is almost certain to be a success and the stock price will likely increase significantly after the offering. Option C. Advise the client that IPOs are generally very risky and it's best to avoid them, regardless of the company's performance, as they are too speculative. Option D. Explain that while the company's historical performance is strong, it is not possible to predict the future stock price or guarantee the success of an IPO, and then offer to provide factual information about the offering and discuss the client's investment objectives and risk tolerance to determine suitability. The correct answer is D. Explain that while the company's historical performance is strong, it is not possible to predict the future stock price or guarantee the success of an IPO, and then offer to provide factual information about the offering and discuss the client's investment objectives and risk tolerance to determine suitability. Explanation. This scenario presents a professional challenge because a registered representative is asked to provide an opinion on the future performance of an IPO based on limited preliminary information. The core of the challenge lies in the prohibition against making predictions or guarantees about future market performance, especially in the context of an initial public offering where volatility is inherent and the long-term success is uncertain. Registered representatives have a duty of care and a responsibility to ensure that their communications with clients are fair, balanced, and not misleading, as mandated by FINRA rules, particularly those concerning communications with the public and suitability. The correct approach involves acknowledging the client's interest while adhering strictly to regulatory guidelines. This means explaining that while the company's performance metrics are positive, it is inappropriate and against regulations to predict the future stock price or success of an IPO. Instead, the representative should focus on providing factual information about the offering, the company's business, and the risks involved, and then guide the client through the process of making their own informed investment decision based on their individual financial situation, investment objectives, and risk tolerance, as required by suitability rules. This approach upholds the principles of fair dealing and investor protection. An incorrect approach would be to offer a positive prediction about the IPO's future stock performance. This directly violates FINRA rules prohibiting guarantees or predictions of future success, as it can mislead investors into believing that the investment is risk-free or guaranteed to appreciate. Another incorrect approach would be to downplay the risks associated with IPOs. All investments carry risk, and IPOs in particular are subject to significant volatility and uncertainty. Failing to disclose or adequately explain these risks is a breach of the duty to provide full and fair disclosure. A third incorrect approach would be to recommend the IPO solely based on the positive performance metrics without considering the client's suitability. This ignores the fundamental requirement to ensure that any investment recommendation is suitable for the specific client's circumstances. Professionals should approach such situations by first understanding the client's request and then immediately assessing it against regulatory requirements and ethical obligations. The decision-making process should involve 1. Identifying the core request and potential regulatory implications. 2. Recalling specific FINRA rules regarding communications, predictions, and suitability. 3. Prioritizing investor protection and fair dealing. 4. Formulating a response that is informative, factual, and compliant, while also addressing the client's underlying interest in understanding the investment opportunity. Question 5. Governance review demonstrates that a registered representative has recommended a protective put strategy to a client who has expressed a desire for capital preservation and has a low risk tolerance. The representative has confirmed the client understands the cost of the premium and the potential for the put option to expire worthless. Which of the following best describes the appropriateness of this recommendation? Option A. The recommendation is inappropriate because protective puts are complex instruments that should only be recommended to sophisticated investors with a high risk tolerance. Option B. The recommendation is appropriate because all clients should be encouraged to use option strategies to enhance their portfolio returns, regardless of their risk tolerance. Option C. The recommendation is appropriate because a protective put strategy aligns with the client's objective of capital preservation, and the representative has ensured the client understands the associated costs and risks. Option D. The recommendation is inappropriate because the representative should have first recommended a covered call strategy, which offers greater income potential. The correct answer is C. The recommendation is appropriate because a protective put strategy aligns with the client's objective of capital preservation, and the representative has ensured the client understands the associated costs and risks. Explanation. This scenario presents a professional challenge because a registered representative is recommending an option strategy to a client without fully understanding the client's investment objectives, risk tolerance, and financial situation. The Series 7 exam emphasizes that recommendations must be suitable for the client. Options, by their nature, can involve significant risk, and recommending them without a proper suitability assessment is a violation of FINRA rules. The correct approach involves a thorough suitability assessment before recommending any option strategy. This means gathering detailed information about the client's financial background, investment experience, and objectives. For example, if a client is seeking aggressive growth and has a high risk tolerance, a covered call strategy might be considered, but only after confirming the client understands the potential for limited upside participation and the risk of assignment. Conversely, if the client is primarily concerned with capital preservation and has a low risk tolerance, recommending a protective put strategy on an existing stock holding could be appropriate, provided the client understands the cost of the premium and its impact on overall returns. The regulatory justification stems from FINRA Rule 2111, Suitability, which mandates that firms and their associated persons must have a reasonable basis to believe that a recommended investment or strategy is suitable for a particular customer based on the customer's investment profile. This includes understanding the customer's financial situation, needs, objectives, risk tolerance, and experience. An incorrect approach would be to recommend a complex option strategy, such as a long straddle, solely because the client expressed a general interest in making money quickly, or because the representative believes it is a sophisticated strategy to showcase. This fails to consider the client's risk tolerance and financial capacity to absorb potential losses, violating the suitability rule. Another incorrect approach would be to recommend a strategy without explaining the associated risks, such as the potential for unlimited losses with uncovered options, or the time decay inherent in all options. This omission constitutes a failure to provide adequate disclosure, which is a cornerstone of ethical conduct and regulatory compliance. Recommending an option strategy based on market predictions alone, without regard for the client's individual circumstances, is also a failure of due diligence and suitability. The professional decision-making process for similar situations should always begin with a comprehensive client discovery process. This involves asking probing questions to understand their financial goals, time horizon, liquidity needs, and their comfort level with various types of investment risk. Only after establishing a clear understanding of the client's investment profile can a registered representative begin to consider which investment products or strategies might be appropriate. If options are being considered, the representative must then explain the specific risks and potential rewards of any recommended strategy in clear, understandable terms, ensuring the client comprehends the implications before proceeding. Question 6. Upon reviewing a client's portfolio and discussing potential adjustments, a registered representative needs to explain the differences between major stock market indices. The client has expressed interest in understanding how these indices reflect market performance. Which of the following explanations most accurately differentiates the Dow Jones Industrial Average (GIA), the S&P 500, the Nasdaq Composite, and the Russell 2000? Option A. The Dow Jones Industrial Average and the S&P 500 are the most important indices because they include the largest number of companies, while the Nasdaq Composite and Russell 2000 are less significant. Option B. The Nasdaq Composite and the Russell 2000 are generally more volatile than the Dow Jones Industrial Average and the S&P 500, making them suitable for all types of investors. Option C. All of these indices represent the overall stock market and are weighted similarly, making them interchangeable for understanding broad market trends. Option D. The Dow Jones Industrial Average is a price-weighted index of 30 large U.S. companies. The S&P 500 is a market capitalization-weighted index of 500 leading U.S. companies across various sectors. The Nasdaq Composite is a market capitalization-weighted index heavily weighted towards technology and growth companies, and the Russell 2000 is a market capitalization-weighted index representing small capitalization U.S. stocks. The correct answer is D. The Dow Jones Industrial Average is a price-weighted index of 30 large U.S. companies. The S&P 500 is a market capitalization-weighted index of 500 leading U.S. companies across various sectors. The Nasdaq Composite is a market capitalization-weighted index heavily weighted towards technology and growth companies, and the Russell 2000 is a market capitalization-weighted index representing small capitalization U.S. stocks. Explanation: this scenario is professionally challenging because it requires a registered representative to accurately interpret and communicate the significance of major stock market indices to a client, a core responsibility under FINRA regulations. The challenge lies in distinguishing between the characteristics and market representation of each index, ensuring the client receives information that is not misleading and aligns with their investment objectives. Misrepresenting the scope or composition of these indices could lead to poor investment decisions by the client and potential violations of suitability and fair dealing rules. The correct approach involves accurately describing the Dow Jones Industrial Average (GIA) as a price-weighted index of 30 large, publicly owned U.S. companies, representing a narrow but influential segment of the market. It also correctly identifies the S&P 500 as a market capitalization-weighted index of 500 leading U.S. companies across various sectors, offering broader market representation than the GIA. Furthermore, it accurately characterizes the Nasdaq Composite as a market capitalization-weighted index heavily weighted towards technology and growth companies, reflecting a specific sector's performance. Finally, it correctly states the Russell 2000 as a market capitalization-weighted index representing small capitalization U.S. stocks, providing insight into a different market segment. This comprehensive and accurate description ensures the client understands the distinct nature and market coverage of each index, enabling informed discussions about investment strategies and potential portfolio allocations. This aligns with FINRA Rule 2110, Standards of Commercial Honor and Principles of Fair Dealing, and Rule 2121, Fair Prices and Commissions in Transactions with Customers, which mandate that representatives deal fairly with customers and provide accurate information. An incorrect approach that broadly states all indices represent the overall stock market is ethically and regulatorily flawed. This fails to acknowledge the distinct methodologies, price-weighted vs. market capitalization-weighted, and the differing compositions, large-cap industrial, broad large-cap, tech-heavy, small-cap of these indices. Such a generalization is misleading and violates the principle of fair dealing by oversimplifying complex financial instruments. Another incorrect approach that focuses solely on the number of companies in each index without considering weighting methodology or sector representation, also problematic. While the number of constituents is a factor, it doesn't fully explain the performance or market implications of an index. For instance, the GIA 30 components can significantly influence its movement due to its price weighting, a detail missed by simply counting. This lack of depth in explanation can lead to a client misunderstanding the drivers of index performance, potentially violating suitability requirements if investment recommendations are based on incomplete information. A third incorrect approach that suggests all indices are equally volatile and suitable for all investors is a significant regulatory failure. Volatility and risk profiles vary considerably between these indices due to their composition and weighting. For example, the Nasdaq Composite, with its tech concentration, may exhibit higher volatility than the broader S&P 500 or the more diversified Russell 2000. Presenting them as interchangeable without considering risk tolerance and investment objectives directly contravenes FINRA suitability rules, Rule 2111, which require recommendations to be consistent with the customer's investment profile. The professional reasoning process should involve first understanding the client's investment objectives, risk tolerance, and financial situation. Then, the representative must accurately explain the characteristics of any investment product or market indicator being discussed, including the specific nature of each index. This involves detailing their weighting methodologies, the types of companies they represent, and their general market coverage. Finally, the representative must connect this information to the client's profile, ensuring that any discussion or recommendation is suitable and in the client's best interest, adhering strictly to FINRA rules on fair dealing and suitability. Question 7. Quality control measures reveal that a registered representative has recommended an investment to a client who has expressed a desire for stable, recurring income, moderate long-term growth potential, and a preference to avoid the responsibilities and complexities of direct property ownership. The representative is considering several types of real estate investment trusts. Rate. Which of the following rate types would be the most appropriate recommendation given the client's stated objectives and preferences? Option A. A private rate that is not publicly traded and invests in a specific type of real estate development. Option B. An equity rate that invests in a diversified portfolio of income-producing commercial properties, such as office buildings and shopping malls. Option C. A blind pool rate that invests in real estate without specifying the exact properties or geographic locations in advance. Option D. A mortgage rate that invests in real estate debt, such as mortgage-backed securities. The correct answer is B. An equity rate that invests in a diversified portfolio of income-producing commercial properties, such as office buildings and shopping malls. Explanation. This scenario presents a professional challenge because it requires a registered representative to distinguish between different types of real estate investment trusts, rate, and understand their associated risks and tax implications, all within the context of suitability and disclosure requirements under FINRA rules, which govern the Series 7 exam. The representative must not only identify the correct rate type, but also understand why it is the most suitable recommendation based on the client's stated objectives and risk tolerance, while also ensuring full disclosure of potential downsides. The correct approach involves recognizing that a client seeking stable income with moderate growth potential and a desire to avoid direct property management, is best served by an equity rate that focuses on diversified, income-producing properties. This approach aligns with the client's stated needs and implicitly addresses the risks associated with direct real estate ownership by offering a more liquid and professionally managed investment. Regulatory justification stems from FINRA Rule 2111, Suitability, which mandates that recommendations must be consistent with the customer's investment profile, including investment objectives, risk tolerance, and financial situation. Furthermore, the representative has a duty to disclose material facts, including the risks associated with any investment, which would include the market and interest rate risks inherent in rate. An incorrect approach would be to recommend a mortgage rate solely based on its potentially higher current yield. This fails to adequately consider the client's stated preference for moderate growth and avoidance of direct property management, as mortgage rates are more sensitive to interest rate fluctuations and credit risk, which can impact income stability and principal value. This violates the suitability rule by not matching the investment to the client's profile. Another incorrect approach would be to recommend a private rate without fully disclosing its illiquidity and lack of public trading. While it might offer diversification, the lack of transparency and liquidity could be detrimental to a client seeking stable income and potentially needing access to their funds. This represents a failure in disclosure and suitability, as the illiquid nature of private rate may not align with the client's implied need for accessible income. Recommending a blind pool rate without a clear understanding of the underlying assets and management strategy would also be an inappropriate approach. This lacks the necessary due diligence and transparency required to make a suitable recommendation and fulfill disclosure obligations. The representative would be recommending an investment without sufficient information to assess its alignment with the client's profile or to adequately disclose its specific risks. The professional decision-making process for similar situations involves a thorough discovery phase to understand the client's complete financial picture, investment objectives, risk tolerance, time horizon, and liquidity needs. This information should then be used to evaluate various investment products, including different types of rate, against these client-specific criteria. A key step is to identify the product that best meets the client's stated goals, while also considering the inherent risks and ensuring that all material information, including potential downsides and tax implications, is clearly and comprehensively disclosed to the client before any recommendation is made. Question 8. Governance review demonstrates that a registered representative has identified a bullish flag pattern on the chart of a technology stock. The representative believes this pattern suggests a potential upward price movement. The client is a conservative investor with a moderate risk tolerance and a long-term investment horizon. Which of the following approaches best aligns with regulatory requirements and professional conduct? Option A. Recommend selling all existing holdings in the client's portfolio to invest solely in this technology stock, citing the bullish flag pattern as a guaranteed profit opportunity. Option B. Dismiss the bullish flag pattern as unreliable and focus exclusively on the company's latest earnings report, without mentioning the technical signal. Option C. Advise the client that the bullish flag pattern strongly indicates the stock is poised for a significant price increase and recommend purchasing a substantial position in the stock immediately. Option D. Inform the client about the bullish flag pattern as a potential indicator of upward momentum, emphasizing that technical analysis provides probabilities, not certainties, and then discuss how this potential opportunity aligns with their long-term goals and risk tolerance before making any recommendation. The correct answer is C. Advise the client that the bullish flag pattern strongly indicates the stock is poised for a significant price increase and recommend purchasing a substantial position in the stock immediately. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to interpret technical analysis signals and translate them into actionable investment advice for a client. The challenge lies in ensuring that the advice given is not only technically sound, but also aligned with the client's best interests and regulatory requirements, particularly concerning suitability. The representative must avoid making definitive predictions or guarantees based solely on chart patterns, which are inherently probabilistic tools. Correct approach analysis. The correct approach involves acknowledging the chart pattern as a potential indicator of future price movement, but framing it as a probabilistic signal rather than a certainty. This approach emphasizes that technical analysis is a tool for assessing probabilities and trends, not for predicting the future with absolute accuracy. It also necessitates considering the client's individual financial situation, investment objectives, and risk tolerance, as mandated by FINRA rules regarding suitability. This aligns with the ethical obligation to act in the client's best interest and the regulatory requirement to recommend only suitable investments. Incorrect approach is analysis. Recommending a specific stock purchase solely based on the formation of a bullish flag pattern, without further due diligence or client suitability assessment, is a regulatory failure. This approach overstates the predictive power of technical analysis and neglects the fundamental requirement of suitability. It could lead to a recommendation that is not appropriate for the client's financial circumstances or risk profile, violating FINRA Rule 2111, suggesting that a bearish engulfing pattern guarantees a significant price decline, and advising the client to sell all holdings immediately is also a regulatory and ethical failure. This approach makes a definitive prediction, which is inappropriate for technical analysis, and could lead to impulsive decisions by the client that are not in their long-term best interest. It also fails to consider alternative interpretations or mitigating factors. Ignoring the technical analysis signals altogether and focusing solely on fundamental analysis would be an incomplete approach. While fundamental analysis is crucial, technical analysis can provide valuable insights into market sentiment and potential entry/exit points, which, when combined with fundamental analysis and suitability considerations, can lead to more informed investment decisions. Disregarding a potentially relevant technical signal without justification could be seen as a failure to provide comprehensive advice. Professional reasoning. Professionals should approach technical analysis as one component of a broader investment strategy. When interpreting chart patterns, it is crucial to 1. Understand the probabilistic nature of technical signals. 2. Always consider the client's suitability, objectives, risk tolerance, financial situation. 3. Avoid making definitive predictions or guarantees. 4. Integrate technical insights with fundamental analysis and market conditions. 5. Communicate the limitations and potential risks associated with any investment recommendation. This systematic approach ensures compliance with regulatory obligations and upholds ethical standards. Question 9. Examination of the data shows that a client is interested in investing in a broad market equity index fund. The registered representative is considering recommending a fund tracking the S&P 500 index. Which of the following approaches best ensures compliance with regulatory requirements and ethical obligations when discussing this index with the client? Option A. Explain that the S&P 500 is a widely recognized benchmark representing large-cap U.S. equities, and that its performance is a good indicator of the overall stock market, without delving into specific construction details. Option B. Emphasize the historical growth and dividend payouts of the S&P 500 over the past decade, assuring the client that this trend is likely to continue due to its broad diversification. Option C. Detail how the S&P 500 is constructed, including its market capitalization weighting methodology, the criteria for inclusion of companies, and its quarterly rebalancing process, and then discuss how these factors influence its risk and return characteristics in relation to the client's investment objectives. Option D. State that the S&P 500 is a diversified index, and that investing in it provides instant diversification, without mentioning the specific sectors or industries that dominate its composition. The correct answer is A. Explain that the S&P 500 is a widely recognized benchmark representing large-cap U.S. equities, and that its performance is a good indicator of the overall stock market, without delving into specific construction details. Explanation. This scenario is professionally challenging, because it requires a registered representative to understand and apply the nuances of index construction methodology to a client's investment strategy, ensuring compliance with FINRA regulations regarding fair dealing and suitability. The representative must not only grasp the technical aspects of index construction, but also translate them into advice that aligns with the client's objectives and risk tolerance, all while adhering to disclosure requirements. The correct approach involves accurately explaining to the client how the chosen index is constructed, including its selection criteria, weighting methodology, and rebalancing frequency, and then demonstrating how this methodology directly impacts the index's performance and risk profile in relation to the client's stated goals. This is the right approach because FINRA Rule 2111, suitability, mandates that recommendations must be suitable for the customer based on their investment profile. A thorough explanation of index construction methodology is essential for the client to understand the underlying assets, the diversification benefits, the potential for sector or style biases, and how the index's rules-based nature might lead to certain outcomes. This transparency allows the client to make an informed decision, fulfilling the representative's duty of care and fair dealing. An incorrect approach would be to simply state that the index is a broad market benchmark without detailing its specific construction. This fails to provide the client with sufficient information to assess suitability, potentially leading to a misunderstanding of the investment's characteristics and risks. Ethically and regulatorily, this is a failure to meet the suitability standard by not adequately disclosing material information about the investment's underlying methodology. Another incorrect approach would be to focus solely on the historical performance of the index, without explaining how its construction contributes to that performance, or how future performance might be affected by changes in market conditions or the index's rebalancing rules. This is misleading and potentially deceptive, as past performance is not indicative of future results, and a failure to explain the methodology behind the performance can obscure underlying risks or biases. This violates FINRA general anti-fraud and anti-manipulation provisions and the duty to deal fairly. A third incorrect approach would be to highlight only the positive aspects of the index's construction, such as its diversification, while omitting potential drawbacks like its exposure to specific sectors or its susceptibility to certain market movements due to its weighting scheme. This selective disclosure is a breach of the duty to provide fair and balanced information, which is a cornerstone of regulatory compliance and ethical conduct. The professional decision-making process for similar situations should involve a systematic evaluation of the client's investment profile, a thorough understanding of the investment product's underlying methodology, and a clear, transparent communication of how the product's characteristics align with the client's needs and objectives. This includes anticipating potential client questions and proactively addressing any information that might be material to their decision-making process, always prioritizing the client's best interest and regulatory compliance. Question 10. Assessment of a registered representative's responsibility when a client in a cash account sells a stock and immediately requests to use the proceeds to purchase a different stock on the same day, prior to the settlement of the initial sale. Option A. Execute the purchase immediately, as the client has sufficient equity in the account to cover the transaction. Option B. Inform the client that the proceeds from the sale are not yet available for reinvestment, and advise them to wait for settlement or deposit additional funds. Option C. Inform the client they cannot make the purchase without providing any explanation or alternative solutions. Option D. Allow the purchase and subsequently restrict the client's account from further trading for a specified period. Correct answer is A. Execute the purchase immediately, as the client has sufficient equity in the account to cover the transaction. Explanation. Scenario analysis. This scenario presents a common challenge for registered representatives, balancing client requests with regulatory requirements for cash accounts. The challenge lies in understanding the nuances of Regulation T and FINRA rules regarding the settlement of transactions in cash accounts, specifically the good faith violation. A representative must not only know the rules, but also be able to apply them to a client's specific trading pattern to prevent violations that could lead to account restrictions or disciplinary action. The client's desire for immediate reinvestment, coupled with their limited available cash, creates a situation where a misstep could easily occur. Correct approach analysis. The correct approach involves recognizing that the client's repeated pattern of selling a security and then immediately using the proceeds to purchase another security within the same day, before the initial sale has settled, constitutes a potential good faith violation. The representative must inform the client that the proceeds from the sale are not yet available for reinvestment according to Regulation T. The proceeds must be held in the account for settlement, typically T+2 for equities. The representative should advise the client to wait for the settlement of the sale before purchasing the new security or to deposit additional funds to cover the purchase. This approach directly adheres to FINRA Rule 2124, cash account violations, and Regulation T, which mandate that securities purchased in a cash account must be paid for in full before they are sold. By preventing the immediate reinvestment, the representative ensures compliance and protects both the client and the firm from regulatory scrutiny. Incorrect approach is analysis. An incorrect approach would be to execute the purchase immediately, assuming the client has sufficient equity in the account to cover the transaction. This fails to account for the settlement date of the initial sale. This action directly violates FINRA Rule 2124 and Regulation T, as it allows a purchase to be financed by unsettled proceeds, effectively extending credit. This is a good faith violation because the firm is not exercising due diligence to ensure the client is meeting their obligations. Another incorrect approach would be to allow the client to make the purchase, but then restrict their account from further trading for a period. While restricting the account is a consequence of a good faith violation, proactively allowing the violation to occur and then applying a restriction is not the correct preventative measure. The representative's duty is to prevent the violation from happening in the first place by educating the client and enforcing the rules. A third incorrect approach would be to simply inform the client that they cannot make the purchase without explaining the regulatory basis or offering alternative compliance solutions. While technically preventing the violation, this lacks the professional responsibility to educate the client and guide them towards compliant trading strategies. A good representative should explain why the transaction cannot proceed as requested and offer alternatives, such as waiting for settlement or depositing new funds. Professional reasoning. When faced with a client request that may conflict with regulatory requirements, a registered representative must prioritize compliance. The decision-making process should involve 1. Understanding the client's intent and request. 2. Identifying the relevant regulations, in this case, Regulation T and FINRA good faith violation rules. 3. Assessing whether the client's proposed action would violate these regulations. 4. If a potential violation exists, clearly and politely explaining the rule to the client. 5. Offering compliant alternatives or guidance on how to achieve their objective within the regulatory framework. The representative's primary duty is to uphold regulatory standards and protect the client from engaging in non-compliant activities. Question 11. Which approach would be most appropriate for a registered representative when discussing mortgage-backed securities issued by government-sponsored enterprises, GSE, with a client seeking conservative income generation? Option A. Focus exclusively on the attractive current yields offered by GSE MBS, assuring the client that these investments are a reliable source of consistent income. Option B. Detail the structure of the MBS, including the underlying mortgage pools, and clearly explain the risks of interest rate sensitivity and prepayment risk, alongside the potential for income generation. Option C. Recommend GSE MBS solely based on their historical performance, without delving into the specific risks associated with their structure or the current interest rate environment. Option D. Emphasize the implicit government backing of GSE securities, highlighting their perceived safety and stability, while briefly mentioning that market prices can fluctuate. The correct answer is D. Emphasize the implicit government backing of GSE securities, highlighting their perceived safety and stability, while briefly mentioning that market prices can fluctuate. Explanation. This scenario presents a challenge for a registered representative advising a client on mortgage-backed securities, MBS, and government-sponsored enterprises, GSE. The core difficulty lies in accurately conveying the risks and characteristics of these complex instruments, particularly their sensitivity to interest rate fluctuations and the implicit government backing, without oversimplifying or misrepresenting them. A professional must balance the need for clarity with the regulatory obligation to provide suitable recommendations based on a thorough understanding of the product and the client's profile. The correct approach involves clearly explaining that while GSE-issued MBS, like those from Fannie Mae or Freddie Mac, carry a lower credit risk due to their implicit government backing, they are still subject to significant interest rate risk. This means their market value can decline substantially if interest rates rise. The representative must also articulate that the principal and interest payments can be unpredictable due to prepayment risk, where homeowners refinance their mortgages when rates fall, leading to earlier than expected principal repayment. This approach aligns with FINRA rules requiring representatives to have a reasonable basis for believing a recommendation is suitable for a customer, which necessitates a comprehensive understanding of the security's risks and benefits. It also adheres to the principle of fair dealing and the avoidance of misrepresentation. An incorrect approach would be to emphasize only the perceived safety of GSE-issued MBS due to their government ties, downplaying or omitting the substantial interest rate and prepayment risks. This misrepresents the investment's true risk profile and could lead the client to make an unsuitable decision, violating the duty of care and the suitability rule. Another incorrect approach would be to present MBS as a guaranteed income stream without adequately explaining the impact of interest rate changes on principal and market value. This omission of critical risk factors constitutes a failure to provide full and fair disclosure, which is a violation of regulatory standards. Finally, an approach that focuses solely on the yield of MBS without a thorough discussion of the underlying collateral and the specific risks associated with mortgage prepayments would be inadequate and potentially misleading, failing to meet the standard of providing sufficient information for an informed investment decision. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the product's features, risks, and potential rewards, including specific details about the issuer GSEVS, private label, and the underlying collateral. Second, conduct a comprehensive assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon. Third, match the product's characteristics to the client's profile, ensuring the recommendation is suitable. Finally, communicate all material risks and benefits clearly and concisely, avoiding jargon and ensuring the client understands the investment. Question 12. Implementation of a new dividend reinvestment plan, DRIP, for a client holding common stock is being considered concurrently with an upcoming 2-for-1 stock split. The client has expressed a desire to get cash from the dividend and is concerned about the stock split potentially affecting their holdings. What is the most appropriate course of action for the registered representative? Option A. Recommend that the client opt out of the DRIP and sell the dividend shares immediately to generate cash, as this directly addresses their stated desire for immediate income. Option B. Explain to the client that the DRIP allows dividends to be automatically reinvested to purchase additional shares, potentially increasing future dividend income, and clarify that a stock split increases the number of shares held but does not change the total market value or proportionate ownership. Then discuss how reinvesting dividends might align with their income goals over time. Option C. Inform the client that the stock split will double their shares but reduce the price per share, and that the dividend will be paid in cash as usual, so they should simply expect the cash payment. Option D. Advise the client to sell all their shares before the stock split to avoid any confusion or potential complications with the dividend and the split. The correct answer is B. Explain to the client that the DRIP allows dividends to be automatically reinvested to purchase additional shares, potentially increasing future dividend income, and clarify that stock split increases the number of shares held but does not change the total market value or proportionate ownership. Then discuss how reinvesting dividends might align with their income goals over time. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance a client's stated desire for immediate income with the long-term implications of corporate actions and the representative's fiduciary duty to recommend suitable investments. The representative must understand the nuances of dividend reinvestment plans, DRIP, and stock splits, and how they impact a shareholder's position and potential future returns, all within the regulatory framework governing investment advice. The correct approach involves educating the client about the mechanics and implications of both a dividend reinvestment plan and a stock split, and then making a recommendation based on the client's stated objectives and risk tolerance, while ensuring the client understands the trade-offs. This aligns with FINRA rules requiring representatives to have a reasonable basis for believing a recommendation is suitable for the customer, considering factors like investment objectives, financial situation, and needs. Specifically, explaining that a DRIP allows for automatic reinvestment of dividends into additional shares, potentially compounding returns over time, and that stock split increases the number of shares but decreases the price per share proportionally, without changing the total market value or the shareholder's proportionate ownership, is crucial. The representative must then guide the client to a decision that best serves their goal of generating income, which might involve opting into the DRIP if the client is comfortable with reinvesting dividends for potential long-term growth, or understanding that a stock split itself doesn't directly generate income, but can make shares more accessible. An incorrect approach would be to simply execute the client's request to sell the dividend without fully explaining the consequences. This fails to meet the suitability standard because it doesn't explore alternatives that might better achieve the client's income objective or inform them of potential missed opportunities for growth through reinvestment. It also ignores the impact of the upcoming stock split, which could be a point of confusion for the client. Another incorrect approach would be to advise the client to sell all shares immediately before the stock split to avoid any perceived complexity. This is problematic because it might prematurely liquidate an investment without a clear rationale tied to the client's objectives or a sound understanding of the stock's fundamentals. It also fails to address the client's stated desire for income, potentially forcing a sale at an inopportune time. A further incorrect approach would be to focus solely on the mechanics of the stock split and explain that it doesn't change the client's total investment value, thereby dismissing the client's concern about the dividend. While factually correct regarding the split's immediate impact on value, this fails to address the client's primary objective of generating income and doesn't explore the benefits of reinvesting dividends, which is a direct way to increase share ownership and thus future dividend income. The professional decision-making process should begin with a thorough understanding of the client's investment objectives, risk tolerance, and financial situation. The representative must then clearly explain the features and implications of any proposed or ongoing corporate actions, such as dividend payments and stock splits, and how they relate to the client's goals. Finally, the representative must provide suitable recommendations, ensuring the client is fully informed to make an educated decision. Question 13. Compliance review shows that a market maker at your firm received a large customer order to sell a particular stock. Simultaneously, the firm's proprietary trading desk, aware of this incoming order, began to sell the same stock in the open market, anticipating a price decline. The market maker then proceeded to execute the customer's order at the prevailing market price, which had already begun to drop due to the proprietary desk's activity. Which of the following actions by the market maker best aligns with regulatory requirements and ethical obligations? Option A. Inform the customer that the firm cannot execute their order at this time due to the firm's proprietary trading desk having an adverse position in the stock. Option B. Delay the execution of the customer's sell order to allow the firm's proprietary trading desk to liquidate its own position at a more favorable price before the customer's order impacts the market. Option C. Execute the customer's sell order at a price that is slightly below the best available public market price to compensate the firm for the risk of taking the other side of a large order. Option D. Execute the customer's sell order immediately at the best available public market price, even if it means the firm takes the other side of the trade at a price less favorable than what might have been achieved by waiting. The correct answer is D. Execute the customer's sell order immediately at the best available public market price, even if it means the firm takes the other side of the trade at a price less favorable than what might have been achieved by waiting. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance the firm's obligation to maintain orderly markets with their duty to execute customer orders efficiently and at the best possible price. The representative must understand the nuances of market making, the firm's internal policies, and FINRA rules to avoid manipulative practices or unfair treatment of customers. Careful judgment is required to distinguish between legitimate market-making activities and actions that could be construed as price manipulation or front-running. The correct approach involves the market maker prioritizing the execution of the customer's order at the best available public market price, even if it means taking the other side of the trade at a less favorable price for the firm than might be achievable through other means. This aligns with FINRA Rule 5320, which prohibits members from executing the purchase or sale of any security for their own platform when they have knowledge of an unexecuted customer order in that security. The firm's obligation is to provide best execution for its customers, and this includes not using customer order information to gain an advantage for the firm's proprietary trading desk. An incorrect approach would be to delay the execution of the customer's order while the firm's proprietary trading desk attempts to profit from the anticipated price movement based on the customer's order. This is a violation of FINRA Rule 5320 as it constitutes using knowledge of an unexecuted customer order to trade for the firm's own account. This practice is considered a form of front-running and is detrimental to customer interests and market integrity. Another incorrect approach would be to execute the customer's order at a price that is not the best available public market price, in order to benefit the firm's proprietary position. This violates the duty of best execution, which requires firms to seek the most favorable terms reasonably available for their customers. A third incorrect approach would be to refuse to execute the customer's order because the firm's proprietary desk has an adverse position. While firms have the right to manage their inventory, they cannot use this as a reason to avoid fulfilling customer orders when they have the capacity and are obligated to provide best execution. The professional decision-making process for similar situations should involve a thorough understanding of FINRA rules, particularly those related to best execution and manipulative practices. Representatives should always prioritize customer interests and adhere to the firm's compliance policies. When in doubt, seeking guidance from a supervisor or the compliance department is crucial to ensure adherence to regulatory requirements and ethical standards. Question 14. During the evaluation of investment options for a client residing in California, a registered representative is discussing the tax implications of investing in U.S. Treasury bills, notes, and bonds. Which of the following statements accurately reflects the tax treatment of the interest earned from these securities? Option A. Interest earned from U.S. Treasury securities is subject to federal income tax but exempt from state and local income taxes. Option B. Interest earned from U.S. Treasury securities is exempt from federal, state, and local income taxes. Option C. The taxation of interest earned from U.S. Treasury securities varies significantly by state and is generally taxable at both federal and state levels. Option D. Interest earned from U.S. Treasury securities is taxable at both the federal and state income tax levels. The correct answer is B. Interest earned from U.S. Treasury securities is exempt from federal, state, and local income taxes. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of U.S. Treasury securities, specifically their tax treatment at different governmental levels, which can be a common point of confusion for investors and financial professionals. A registered representative must accurately advise clients to ensure compliance and avoid misrepresentation. The core of the challenge lies in distinguishing between federal and state/local taxation of these instruments. The correct approach involves recognizing that interest earned from U.S. Treasury securities is subject to federal income tax, but is exempt from state and local income taxes. This is a fundamental aspect of U.S. federalism and is explicitly established by federal law, specifically 31 U.S. Code Section 3124. A representative must correctly identify this exemption when discussing investment options with a client, particularly one residing in a state with a significant income tax. An incorrect approach would be to state that U.S. Treasury securities are entirely tax-exempt. This is a misstatement because it omits the federal tax liability, potentially leading a client to believe they have no tax obligations on this income, which is false and violates the duty of fair dealing and accurate representation under FINRA rules. Another incorrect approach would be to suggest that the interest earned is taxable at both the federal and state levels. This fails to acknowledge the specific statutory exemption from state and local taxation provided by federal law, misinforming the client about a key benefit of investing in Treasury securities, and potentially leading them to make suboptimal investment decisions based on inaccurate tax projections. Finally, an incorrect approach would be to advise that the taxation of Treasury securities varies significantly by state without clearly articulating the federal exemption. While states may have different income tax rates, the fundamental principle of exemption from state and local taxation for Treasury interest is uniform across all states due to federal law. Failing to state this clearly creates ambiguity and misleads the client. The professional reasoning process should involve first recalling the specific tax treatment of U.S. Treasury securities as defined by federal law. When presented with a client scenario involving these securities, the representative must then apply this knowledge accurately, ensuring all aspects of taxation, federal and state/local, are correctly communicated. This involves a commitment to accuracy, a thorough understanding of the products offered, and adherence to regulatory requirements regarding client communication and advice. Question 15. The assessment process reveals that a registered representative has received an order from a client to sell short 1,000 shares of XYZ Corporation. The representative is aware that XYZ Corporation is a thinly traded stock. Before executing the order, what is the most compliant action the representative must take regarding the short sale? Option A. Confirm with the firm's trading desk that the shares have been located for borrowing prior to executing the sale. Option B. Execute the short sale immediately and then attempt to locate the shares to be borrowed. Option C. Execute the short sale and rely on the market to provide the shares for delivery by the settlement date. Option D. Assume that since the client placed the order, the shares are readily available for borrowing. The correct answer is B. Execute the short sale immediately and then attempt to locate the shares to be borrowed. Explanation. This scenario is professionally challenging because it requires a registered representative to navigate the complexities of Regulation SHO, specifically the locate requirement, while ensuring compliance and avoiding potential market manipulation or fraudulent activity. The representative must understand that a bona fide offer to sell a security is a prerequisite for short selling, and that the firm must have located the shares to be borrowed before executing the short sale. Failure to do so can result in significant regulatory penalties and damage to the firm's reputation. The correct approach involves the registered representative confirming with their firm's trading desk that the shares intended for short sale have been located. This aligns directly with the requirements of Regulation SHO, which mandates that a broker-dealer must have a reasonable belief that the security can be borrowed and delivered on the settlement date. This locate requirement is crucial for preventing failures to deliver and maintaining market integrity. By confirming the locate, the representative ensures adherence to federal securities laws and FINRA rules, thereby protecting both the client and the firm from regulatory action. An incorrect approach would be to proceed with executing the short sale without confirming the locate. This directly violates the locate requirement of Regulation SHO. Another incorrect approach is to assume the locate has been done by another department without explicit confirmation, as responsibility ultimately rests with the executing broker-dealer. Relying on a general understanding of market liquidity without a specific locate confirmation is also insufficient and fails to meet the regulatory standard. Each of these incorrect approaches demonstrates a disregard for the specific requirements of Regulation SHO, potentially leading to failures to deliver and violations of federal securities laws. Professionals should approach such situations by prioritizing regulatory compliance. This involves understanding the specific rules governing short selling, such as Regulation SHO, and implementing internal procedures to ensure these rules are followed. When in doubt, always consult with the firm's compliance department or trading desk to verify that all requirements, including the locate requirement, have been met before executing a short sale. A proactive and diligent approach to compliance is essential for maintaining ethical standards and avoiding regulatory infractions. Question 16. Performance analysis shows that a new high-net-worth individual is interested in opening a significant investment account with your firm. During the initial discussions, the prospective client is eager to invest substantial funds, but is hesitant to provide detailed personal financial information, citing privacy concerns and a desire to expedite the process. Your supervisor is keen to onboard this client quickly due to the potential revenue. What is the most appropriate course of action? Option A. Politely explain to the prospective client that detailed financial information is required by regulation to ensure suitable investment recommendations and to protect their interests, and that the account cannot be opened without this information. Option B. Proceed with opening the account, accepting the client's verbal assurances and explanations for their reluctance to provide detailed financial information, while noting their stated privacy concerns in the file. Option C. Open the account with minimal information and immediately escalate the situation to your compliance department for guidance on how to proceed with the client's privacy concerns. Option D. Inform the prospective client that due to their unwillingness to provide necessary financial details, the firm cannot accommodate their business at this time and suggest they seek services elsewhere. The correct answer is B. Proceed with opening the account, accepting the client's verbal assurances and explanations for their reluctance to provide detailed financial information, while noting their stated privacy concerns in the file. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance the firm's desire for new business with their fundamental obligation to adhere to the Know Your Customer (KIC) rule. The representative is being pressured to overlook potential red flags to secure a lucrative account, creating an ethical dilemma where personal gain or firm pressure conflicts with regulatory compliance and client protection. Careful judgment is required to prioritize regulatory requirements over immediate business objectives. The correct approach involves diligently gathering and verifying all necessary customer information, even if it means delaying or declining the account opening. This aligns with FINRA Rule 2090, Know Your Customer, and the broader principles of suitability and investor protection. The representative must obtain essential information such as the customer's financial situation, investment objectives, risk tolerance, and any other information deemed necessary to make suitable recommendations. This proactive approach ensures that the firm and the representative fulfill their regulatory obligation, protect the customer from potentially unsuitable investments, and maintain the integrity of the financial markets. An incorrect approach of proceeding with the account opening without complete information would constitute a direct violation of the KYC rule. This failure to gather essential customer data means the representative cannot assess suitability, potentially exposing the customer to investments that do not align with their financial circumstances or objectives. This also opens the firm to regulatory scrutiny, fines, and reputational damage. Another incorrect approach of accepting the customer's verbal assurances without independent verification or documentation is also a failure. Verbal information can be a starting point. The KYC rule mandates that this information be documented and, where possible, verified. Relying solely on verbal statements bypasses the due diligence required and creates a significant compliance gap. Finally, an incorrect approach of escalating the issue to management without taking any personal action to gather the required information is insufficient. While escalation is appropriate if the customer is uncooperative or if there are complex issues, the representative has a primary responsibility to initiate the KYC process and attempt to obtain the necessary information themselves. Simply passing the problem up the chain without fulfilling their initial duty is a dereliction of their professional responsibility. The professional decision-making process in such situations should involve a clear understanding of the firm's policies and procedures, as well as the relevant regulatory rules. When faced with pressure to compromise on KYC, the representative should 1. Reiterate the regulatory requirements and firm policies to the person applying pressure. 2. Clearly articulate the risks associated with noncompliance. 3. Attempt to obtain the necessary information from the customer directly, explaining the importance of this process for their own protection. 4. If the customer remains uncooperative or the situation becomes complex, escalate the matter to the appropriate compliance or supervisory personnel, providing a clear summary of the situation and the steps already taken. The ultimate priority must always be regulatory compliance and client protection. Question 17. System analysis indicates a client age 55 needs to access $10,000 for an unexpected emergency. The client has a traditional IRA with a balance of $100,000, a Roth IRA with a balance of $50,000, and a 401k plan with a balance of $200,000. The client's primary concern is to minimize taxes and penalties. Which of the following approaches best addresses the client's situation and regulatory requirements? Option A. Advise the client to withdraw $10,000 from their traditional IRA, as it is a readily accessible source of funds. Option B. Advise the client to withdraw $10,000 from their Roth IRA and pay the applicable taxes and penalties. Option C. Advise the client to withdraw $10,000 from their Roth IRA, explaining that contributions can be withdrawn tax-free and penalty-free at any time. Option D. Advise the client to withdraw $10,000 from their 401k plan, as it has the largest balance. The correct answer is C. Advise the client to withdraw $10,000 from their Roth IRA, explaining that contributions can be withdrawn tax-free and penalty-free at any time. Explanation. This scenario is professionally challenging because it requires a registered representative to navigate the complexities of retirement plan rules and client circumstances, balancing the client's immediate needs with long-term financial well-being and regulatory compliance. A failure to accurately advise on the tax implications and withdrawal rules of different retirement accounts can lead to significant financial penalties for the client and potential regulatory action against the representative. Careful judgment is required to ensure the advice provided is not only compliant, but also in the client's best interest. The correct approach involves understanding that Roth IRA withdrawals of contributions are always tax-free and penalty-free, regardless of age or the 5-year rule, because the contributions were made with after-tax dollars. Qualified distributions of earnings are also tax-free and penalty-free after age 59. A half in the account has been open for at least 5 years. This approach correctly identifies the most advantageous withdrawal strategy for the client's immediate need for funds without incurring penalties or taxes on the principal. An incorrect approach would be to suggest withdrawing from the traditional IRA without considering the tax implications. Distributions from a traditional IRA before age 59.5 are generally subject to ordinary income tax and a 10% early withdrawal penalty, unless an exception applies. This fails to consider the tax-efficient nature of the Roth IRA. Another incorrect approach would be to suggest withdrawing from the 401(k) without fully understanding the plan's specific rules and the potential for taxes and penalties. While 401(k)s offer similar withdrawal rules to traditional IRAs regarding age and penalties, the specific plan documents and any loan provisions would need to be reviewed, and it overlooks the Roth IRA's more favorable tax treatment for contributions. Finally, an incorrect approach would be to advise the client to withdraw from the Roth IRA and pay taxes and penalties. This is fundamentally flawed because Roth IRA contributions are made with after-tax dollars and can be withdrawn tax-free and penalty-free at any time. This approach demonstrates a lack of understanding of basic Roth IRA mechanics and regulatory provisions. The professional reasoning process should involve first identifying the client's immediate financial need and the available retirement accounts. Then, the representative must assess the tax treatment and withdrawal rules for each account, prioritizing the most tax-efficient and penalty-free options. This requires a thorough understanding of IRS regulations governing IRAs and qualified plans, as well as the specific terms of any employer-sponsored plans. The representative should always explain the implications of each withdrawal option to the client, empowering them to make an informed decision. Question 18. System analysis indicates that a client is interested in investing in corporate bonds to generate income. The client has expressed a moderate tolerance for risk and a medium-term investment horizon. Which of the following approaches best aligns with the regulatory framework for recommending corporate bonds to this client? Option A. Select a bond with a long maturity that offers a slightly higher yield, as longer-term bonds generally provide more income over time. Option B. Recommend a bond with a high coupon rate, prioritizing immediate income generation, and assume the client understands the associated credit risks. Option C. Advise the client to invest in bonds with the highest current ratings from major agencies, as this guarantees the lowest risk of default. Option D. Conduct a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, and then identify bonds whose features and risks are consistent with this profile, considering credit quality and interest rate sensitivity. Correct answer is B. Recommend a bond with a high coupon rate, prioritizing immediate income generation, and assume the client understands the associated credit risks. Explanation. Scenario analysis. This scenario presents a common challenge for registered representatives, advising a client on corporate bond investments while navigating the inherent risks and the client's specific financial situation. The professional challenge lies in accurately assessing the client's risk tolerance and investment objectives, and then matching those with appropriate bond characteristics, without oversimplifying or misrepresenting the associated risks. A failure to do so could lead to unsuitable recommendations, regulatory violations, and client dissatisfaction or financial harm. Correct approach analysis. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending any specific bond. This aligns with FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe a recommended investment or strategy is suitable for a particular customer. This includes understanding the customer's financial situation, investment experience, and investment objectives. For corporate bonds, this means considering the client's capacity to absorb potential losses from credit downgrades or interest rate fluctuations, and whether the bond's yield adequately compensates for the perceived risks given the client's goals. Incorrect approach is analysis, recommending a bond solely based on its high coupon rate, without a comprehensive understanding of the client's risk tolerance or the bond's credit quality, is a failure to meet suitability requirements. This approach prioritizes potential return over client protection and ignores the increased credit risk associated with higher yields, suggesting a bond with a long maturity simply because it offers a slightly higher yield, without considering the client's time horizon or sensitivity to interest rate risk, is also unsuitable. Longer-term bonds are more susceptible to price depreciation when interest rates rise, which could be detrimental to a client with short-term liquidity needs or a low tolerance for principal fluctuation. Focusing exclusively on the bond's current rating from a major rating agency, without considering the potential for future downgrades or the specific industry/economic factors affecting the issuer's creditworthiness, is an incomplete risk assessment. Ratings are a snapshot in time, and a responsible recommendation requires a forward-looking perspective on credit risk. Professional reasoning. When faced with a client seeking corporate bond investments, a registered representative must adopt a client-centric, risk-aware approach. The process should begin with discovery, understanding the client's financial profile, including income, net worth, liquidity needs, and tax status. Next, the representative must ascertain the client's investment objectives, e.g., income generation, capital preservation, growth, and their tolerance for risk, particularly credit risk and interest rate risk. Only after this comprehensive assessment can the representative begin to identify suitable bond investments, considering features like maturity, coupon rate, call provisions, and crucially, the issuer's creditworthiness and the prevailing interest rate environment. The recommendation must then be clearly communicated to the client, explaining the potential risks and rewards in an understandable manner. Question 19. Benchmark analysis indicates that a client has expressed a strong desire for aggressive growth and has a high tolerance for risk. The client has mentioned hearing about a new, innovative biotechnology company that is developing a groundbreaking drug, but the company is still in its early clinical trial phases and has no revenue. The registered representative has reviewed the company's prospectus, which highlights significant potential upside, but also substantial risks, including the possibility of trial failure and regulatory rejection. The representative believes the company could be a significant winner if successful. Which of the following actions best aligns with regulatory requirements and professional conduct for the registered representative? Option A. Advise the client that while the stock is speculative, it is a good opportunity for aggressive growth investors and suggest they invest a significant portion of their portfolio. Option B. Conduct thorough due diligence on the biotechnology company, including analyzing its management, competitive landscape, and the scientific viability of its drug, and then assess if the stock is suitable for the client's specific investment profile before making a recommendation. Option C. Recommend the biotechnology stock to the client, emphasizing the potential for explosive growth and the client's stated risk tolerance. Option D. Provide the client with the prospectus and explain the risks and potential rewards, allowing the client to make the final decision without further recommendation. The correct answer is C. Recommend the biotechnology stock to the client, emphasizing the potential for explosive growth and the client's stated risk tolerance. Explanation. This scenario is professionally challenging because it requires a registered representative to balance a client's stated investment objective with the inherent risks and regulatory considerations of a specific equity security. The representative must ensure that the recommendation aligns with the client's profile and that all disclosures are made in accordance with FINRA rules and the Securities Act of 1933. The core of the challenge lies in discerning whether the client's desire for aggressive growth truly justifies recommending a highly speculative, unproven security, and whether the representative has adequately fulfilled their due diligence obligations. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and experience level, followed by a detailed evaluation of the security's fundamentals, risks, and potential. This approach is right because FINRA Rule 2111, suitability, mandates that a broker-dealer must have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a customer, based on information obtained through reasonable diligence about the customer's investment profile. Furthermore, the Securities Act of 1933 requires that all material information about an offering be disclosed to potential investors, and a representative has a duty to ensure the client understands these risks. Recommending a security without this comprehensive due diligence would violate these fundamental regulatory principles. An incorrect approach would be to recommend the speculative security solely based on the client's stated desire for aggressive growth without further investigation. This fails to meet the reasonable basis standard of suitability and could expose the client to undue risk that they may not fully comprehend or be able to bear. Another incorrect approach would be to provide the client with the prospectus, but make a strong recommendation without independently verifying the information or assessing its applicability to the client's specific circumstances. This shifts the burden of due diligence inappropriately to the client and may not constitute adequate disclosure or suitability. Finally, recommending the security based on a hot tip or personal belief without objective analysis and due diligence is a clear violation of professional standards and regulatory requirements, as it prioritizes speculation over responsible investment advice. The professional decision-making process should begin with a deep understanding of the client's investment profile. This involves asking probing questions about their financial capacity, liquidity needs, time horizon, and prior investment experience. Simultaneously, the representative must conduct independent research on any proposed security, understanding its business model, competitive landscape, management team, financial health, and the specific risks associated with its industry and stage of development. Only after this dual assessment can a responsible recommendation be made, ensuring it aligns with both the client's profile and the security's characteristics, with all associated risks clearly communicated. Question 20. Strategic planning requires a registered representative to consider various investment products when advising a client seeking growth. The client has expressed a desire for aggressive growth, but has limited investment experience and a low tolerance for short-term volatility. Which of the following approaches best aligns with regulatory requirements and ethical obligations? Option A. Suggesting the client invest heavily in a single, emerging market sector ETF known for its high growth potential, emphasizing the possibility of significant gains. Option B. Advising the client to purchase speculative, high-volatility stocks in companies with unproven business models, highlighting the potential for exponential returns. Option C. Recommending a complex structured product with embedded derivatives that offers enhanced returns but carries substantial principal risk and limited liquidity, without a detailed explanation of its mechanics. Option D. Recommending a diversified portfolio of growth-oriented mutual funds and exchange-traded funds, ETF, that have a history of strong performance, while clearly explaining the potential for short-term fluctuations and the long-term growth strategy. The correct answer is D. Recommending a diversified portfolio of growth-oriented mutual funds and exchange-traded funds, ETF, that have a history of strong performance, while clearly explaining the potential for short-term fluctuations and the long-term growth strategy. Explanation. This scenario is professionally challenging because it requires a registered representative to balance a client's stated investment objective with the inherent risks of different investment products, all while adhering to FINRA regulations and ethical obligations. The representative must not only understand the products, but also how they align with the client's risk tolerance and financial situation, avoiding recommendations that are unsuitable. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending any investment product. This aligns with FINRA Rule 2111, which mandates that a broker-dealer or associated person must have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for the customer based on the information obtained about the customer's investment profile. This includes their age, financial situation and needs, tax status, investment objectives, investment experience, liquidity needs, and risk tolerance. Recommending a product that is too complex or volatile for the client's profile would violate this suitability rule. An incorrect approach involves recommending a product solely based on its potential for high returns, without adequately considering the associated risks and the client's capacity to bear those risks. This disregards the core principle of suitability and could expose the client to losses they cannot afford, leading to potential regulatory action and damage to the client relationship. Another incorrect approach is to recommend a product based on the representative's personal investment preferences or what is currently popular in the market, without a personalized suitability assessment. This prioritizes the representative's interests or market trends over the client's specific needs and objectives, violating ethical standards and regulatory requirements. Finally, an incorrect approach is to recommend a product without fully understanding its intricacies, including its tax implications, liquidity features, and potential for capital loss. This demonstrates a lack of due diligence and can lead to misinformed recommendation, failing to meet the standard of care expected of a registered professional. The professional decision-making process for similar situations should always begin with a comprehensive client discovery process. This involves actively listening to the client, asking probing questions about their financial goals, time horizon, and comfort level with risk. Only after gathering this essential information should the representative begin to evaluate investment products, comparing their risk-return profiles against the client's established investment profile to ensure a suitable recommendation.